ACC 323. Auditing. Study Session 1. The Legal Framework of Auditing. Introduction. The legal framework defines the statutory environment within which the auditor executes his responsibilities. It speaks of the legal instruments and legal institutions that provide legal certification of the auditor's approach and methodology. The legal framework of auditing. The legal framework defines the statutory environment within which the auditor executes his responsibilities. It speaks of the legal instruments and legal institutions that provide legal certification of the auditor's approach and methodology. Statutory requirements of audits. The statutory requirements of the audit are categorized under legal and professional requirements. 1. Legal requirement. The legal requirements are provided by legal institutions. These institutions are: 1. Companies and Allied Matters Act of Nigeria CAPC 20 LFN 2004. 2. Banks and Other Financial Institutions Acts 1997 amended till date. 3. Insurance Act 1997 as amended till date. 4. The Constitution of the Federal Republic of Nigeria. 2. Professional requirements. As part of the regulatory mechanism to monitor professional accountants' conduct, professional bodies provide guidelines and principles for auditing which the law approves. The fundamental principles with which the auditor is required to comply with the ICANN Code are: 1. Integrity. 2. Objectivity. 3. Professional competence and due care. 4. Confidentiality. 5. Professional behavior. Appointment of auditors. Persons qualified. According to Section 358 of 1990, for a person to qualify for appointment as an auditor of a public company, he must be a member of a recognized professional accountancy body who has been duly licensed to practice by the professional accountancy body of the home/host country. The following persons are not entitled to act as auditors to either a private or a public company: A. An infant. B. A person found by a competent court to be of unsound mind. C. An undercharged bankrupt, except he shall have been granted leave to act as an auditor of the company concerned by the court which adjudged him bankrupt. D. An officer of the company or of any associated company. E. A person who is in the employment of an office or a partner of the company, or of any associated company. Who appoints auditors? Section 357 of Com. Auditors are generally appointed by the shareholders of a company in a general meeting by ordinary resolution and to hold office from the conclusion of the meeting, until the conclusion of the next annual general meeting. The following are also permitted. 1. The directors appoint the first auditors of the company and fill any casual vacancy in the office of the auditor, where at an annual general meeting, no auditors are appointed or reappointed. The directors may appoint a person to fill the vacancy. 2. The registrar of companies or the commissioner to appoint an auditor for a company if the company shall have had no auditors for a continuous period of 3 months. The written consent of a person is necessary before he can be appointed as an auditor. Who fixes the auditor's remuneration? Section 361 of CAM 1990 states that, generally, the auditor's remuneration is fixed by the members of the company in a general meeting by an ordinary resolution or in such manner as the company may determine. However, in the case of an auditor appointed by directors of the company, the remuneration may be fixed by the directors, for the period expiring at the conclusion of the next annual general meeting of the company. Procedure for the audit appointment of auditors. 1. Pre-accepting conditions. 2. Ethical consideration. 3. Legal consideration. 4. Practical consideration. 5. Seeking reference about the client. 6. Communicating with the present auditors. 7. Post-acceptance procedures. Rules and duties of an auditors. The rights of the auditor. 1. Right of access to books of accounts at all times and vouchers of the company. 2. Right to acquire information and explanations from the directors for the performance of the auditor's duties. 3. The right to attend any general meeting of the company and to receive notices of any general meeting on any part of the business of the meeting which concerns them as auditors. 4. The right to apply to the court for directions in relation to any matter arising in connection with the performance of their functions under the code, and to have the costs of any such application met by the company, unless directed by the court. 5. The right, before accepting an appointment as auditor of a company, to communicate with a retiring auditor, if any. Duties of the auditor. 1. To make a report to the members of the company on all accounts and financial statements presented before the members in annual general meeting. 2. To state if the financial statements of the company show a true and fair view and have been properly prepared according to the provisions of the code. 3. To consider if any information in the director's report is consistent with the accounts and to report the facts if there are any of such instances. 4. To outline in his report details of directors' remuneration, loans to officers, transactions involving directors and other connected persons, not disclosed in the financial statements themselves. 5. To make a statement of circumstances when he ceases to hold the office for any reason. Summary of Study Session 1. In this study session, please note the following. 1. We have looked at the legal framework of auditing and we have seen that every company, by law, should have its financial statements audited before circulation to members and other stakeholders. 2. Generally, the auditor is appointed at the annual general meeting by members. Where casual vacancy exists, the directors of the company may appoint an auditor. The auditor's remuneration is determined by the appointing authority. 3. An auditor can also be removed from office by ordinary resolution before the expiration of his term of office. The auditor, by virtue of his appointment, has statutory responsibilities and rights which he cannot compromise in any way. 4. The auditor, by virtue of his appointment and in course of executing his assignment, should demonstrate some professional skills and competencies as well as possessing requisite professional ethics. 5. The auditor also exercises some rights which included, right to attend any general meeting of the company and to receive notices of meetings, right to access books of accounts at all times. Study Session 2. Professional Rules and Guidelines in Auditing. Introduction. The Auditing Frameworks is rules and regulations guiding the implementation of accounting and auditing functions within an enterprise. Professional Rules and Regulations. These are pronouncements of rules and regulations guiding the conduct of an audit normally issued by professional accounting bodies. Examples of these rules and regulations are: 1. The International Financial Reporting Standards, IFRS. 2. The Statement of Auditing Standards, SAS. 3. The International Auditing Guideline, IAG. 4. The Auditing Guideline. Accounting or Auditing Standards. These are pronouncements or standards being issued by professional accounting bodies which state the basic procedures to be adopted by auditors when carrying out audit functions of planning, investigations, and reporting. Their purpose is to give credibility to the profession. Guidelines. These are also pronouncements or statements being issued by professional accounting bodies that state or guide auditors on how the basic procedures contained in the standards are to be applied. Professional bodies. Some of the various professional bodies that issue accounting/auditing frameworks are: 1. American Institute of Certified Public Accountants. 2. Association of Accountancy Bodies in West Africa. 3. Association of Accounting Technicians. 4. Association of Chartered Certified Accountants. 5. Association of International Accountants. 6. Association of National Accountants of Nigeria. 7. Institutes of Chartered Accountants of Nigeria. Objectives or purposes of professional rules, standards, and guidelines. 1. To ensure uniformity in carrying out audit assignments. 2. To serve as a basis for controlling, coordinating, and directing the conduct of an audit within an enterprise. 3. To increase auditors' image in the eyes of the users of financial statements. 4. To ensure quality control of an audit. 5. To minimize engagement risks. Benefits of professional standards and guidelines. 1. It leads to a degree of uniformity among accounts. 2. It assists investors in having a greater understanding of the preparation of accounts. 3. It assists accountants and auditors in the process of determining what is the true and fair view. Limitations or drawbacks in the use of standards and guidelines. 1. Auditing standards or guidelines make auditing works to be too mechanical. 2. They may not cover all the circumstances in which the auditors may find themselves in real practice. 3. The use of standards and guidelines may restrict the initiative of the auditors. 4. Auditing standards and guidelines, if not properly drawn, could mislead the audit staff. Importance of auditing standards. Auditors must comply with the numerous statements of auditing standards, failure of which may result in disciplinary or regulatory action by the appropriate committee of the relevant accountancy body. The professional body may withdraw registration from an auditor who cannot then conduct any company audit and is thus partly deprived of his means of livelihood. Also, it might result in court action for negligence. Auditing standards in general reflect a level of quality of services auditors are required and expected to render to their clients. They reflect actions to be carried out by auditors which are generally accepted as correct and widely used. This is responsible for their sometimes being referred to as generally accepted auditing standards. Summary of Study Session 2. In this study session, please note the following. 1. One of the importance of auditing standards is that the professional body may withdraw registration from an auditor who cannot then conduct any company audit and is thus partly deprived of his means of livelihood. 2. Auditing standards in general reflect a level of quality of services auditors are required and expected to render to their clients. Study Session 3. General Overview of the Audit Process. Introduction. There are various enabling laws in Nigeria such as the Company and Allied Matters Act stipulating the need for an audit of corporate entities, banks, insurance companies. It is therefore pertinent, for the purpose of our objective, to demystify and outline the various activities carried out by an auditor in carrying out an audit, which is the audit process. What is an audit process? An audit process is a series of continuous activities carried out by an auditor from the pre-engagement stage to the completion and review of the engagement before signing the audit opinion. The audit process enables the auditor to obtain the necessary, appropriate, and sufficient audit evidence to form and support his opinion as to whether or not the client's financial statements are free from material misstatement and whether the audit objectives have been met. Objectives and attributes of the audit process. Establishing clear objectives provides a structure and discipline that helps the audit team focus on the expected results and avoid confusion. 1. Accomplishes more with less. 2. Controls and minimizes audit risk. 3. Provides tools for the audit team to conduct an efficient and effective audit. 4. Aids in writing the report. There are 5 attributes of the audit process, which are: 1. Criteria, what should be. 2. Condition, what is. 3. Cause, why the condition happened. 4. Effect, the difference between criteria and condition. 5. Recommendation, actions needed to correct the cause. 3 stages in the audit process. Stage 1. Pre-engagement stage. Professional standards require that audit firms should establish policies and procedures for deciding whether to accept new clients and retain existing clients. Acceptance of new client. Prior to accepting an audit engagement, the firm should consider it. 1. The integrity of the client's principal owners and those charged with governance. For example, thorough background checks. 2. The competence of the firm to perform the audit engagement. 3. Compliance of the firm and the engagement team with ethical requirements, i.e. integrity, objectivity, competence, confidentiality, and professional behavior. 4. Identifying and evaluating circumstances that create threats to independence and taking action to eliminate the threats or reduce them to an acceptable level by applying safeguards. Where there is a change of auditors. 1. The entity has communicated with the outgoing auditor giving him permission to communicate with the firm. 2. The firm writes to the outgoing auditor for professional clearance and requests appropriate information required to decide whether to accept or reject the appointment. Engagements may be declined where: 1. An entity is operating in a specialized industry in which the firm lacks the required expertise and expert assistance is not available. 2. An entity operates a significant branch network where the firm is not represented, and there are no alternative audit procedures that can be adopted to cover these branch operations. 3. A quality control review is required and no suitably qualified and objective reviewer is available. Continuing client engagement. The audit considers the significant matters that may have arisen during the year and their implication on the audit. These could include: 1. Changes in the entity's business, for example expansion into areas where the firm lacks the necessary knowledge or expertise. 2. Changes in the integrity of the principal owners and those charged with governance. 3. Changes in circumstances that affect the independence of the engagement team. 4. Changes in legal, professional, and regulatory requirements, which the entity is unwilling to comply with. 5. Outstanding fees or undue pressure to reduce fees or the scope of work. Engagement letter. Once the decision for acceptance continuance has been made, the auditor and the client need to confirm the terms of the engagement by signing an engagement letter. Contents of engagement letter. 1. Objective and scope of the audit engagement. 2. Responsibilities of the auditor. 3. Responsibilities of the management. 4. Identification of the applicable financial reporting framework. It may also make reference to: 1. The unavoidable risk is that some material misstatements may go undetected due to the inherent limitations in an audit. 2. Arrangements regarding the planning and performance of the audit. 3. The expectation that management will provide written representations. Stage 2. Planning and audit. Planning involves all the issues that the auditor should consider to develop an overall audit strategy and plan for conducting the audit. The outcome of the planning process is a written plan that sets forth the overall audit strategy and the nature, extent, and timing of the audit work. The steps to be followed during the planning phase include: 1. Understanding the entity and its environment. 2. Understanding of internal controls. 3. Assessing the risk of material misstatement. 4. Response to assessed risk, audit strategy, and audit plan. Audit strategy. Factors to be considered in developing an audit strategy include: 1. Scope of the audit. 2. The timing of the audit and reporting deadlines. 3. Financial reporting framework used and industry-specific reporting requirements. 4. Key dates for communicating with management and those charged with governance. 5. Materiality. Audit plan. An audit plan includes the following. 1. Preliminary analytical review. This is a review of key business ratios, trends, and other financial information available at this stage as a risk assessment procedure to obtain an understanding of the entity and its environment. 2. Preliminary risk assessment. A preliminary review of overall risk and key risks in individual audit areas and their impact on the audit is taken into account. 3. Sources of reliance. 4. Materiality. 5. The sampling techniques to be adopted. 6. Audit timetable and requirements. Stage 3. Understanding the entity and its internal control environment. This enables the auditor to identify business risks that may result in material misstatements. The key aspects to be considered are: 1. Industry regulation and other external factors, including the applicable financial reporting framework. 2. Nature of the entity, i.e. business operations, products, key customers and suppliers, related party transactions. 3. Objectives, strategies, and related business risks. 4. Measurement and review of financial performance, e.g. ratios and operating statistics. 5. Entity's internal controls. 6. Consideration of the information system relevant to financial reporting. Stage 4. Risk assessment procedures. The auditor needs to identify and assess risks of material misstatement at both the financial statement level and assertion level. The auditor has to consider both inherent and control risks. The assessed level of risk of material misstatement is used to determine the acceptable level of detection risk and to plan the auditing procedures to be performed. The engagement team is also required to assess the risks of material misstatement due to fraud. Stage 5. Documentation and audit evidence. This stage involves gathering sufficient and appropriate audit evidence on which to base the audit opinion. Audit evidence is all the information, whether obtained from audit procedures or other sources, that are used by the auditor in arriving at the conclusions on which the audit opinion is based. The quality of audit evidence needed is affected by the following. 1. Risk of material misstatements, in the audit of financial statements, or the risk associated with the control in the audit of internal control over financial reporting. 2. Quality of the audit evidence obtained. As the quality of the evidence increases, the need for additional corroborating evidence decreases. Stage 6. Audit completion. Once the auditor has completed gathering evidence relating to the financial statement assertions, the audit enters the completion phases where the sufficiency and appropriateness of the audit gathered are evaluated. Should the auditor determine that sufficient appropriate evidence was not obtained, additional substantive procedures need to be performed. Some of the procedures carried out at the completion stage include: 1. Analytical procedures. Explain material changes and variances to enable the reviewer to corroborate conclusions formed during the audit and assist in arriving at the overall conclusion on the reasonableness of the financial statements. 2. Going concern confirmation. Considering the appropriateness of using the going concern assumption in the preparation of the financial statements. 3. Review of presentation and disclosure. Ensure financial statements comply with IFRS and the Companies Act requirements. 4. Engagement partner review. The engagement partner performs a review of work done to be satisfied that sufficient appropriate audit evidence has been obtained to support the conclusion about the audit report to be issued to the client. Stage 7. Reporting. The final phase in the audit process is to evaluate the results of the audit evidence and choose the appropriate audit to issue. It is here that the auditor expresses the audit opinion, findings and recommendations, and management's responses to the findings. Copies of the report are distributed to all necessary stakeholders. The report can either be qualified or unqualified. Summary of Study Session 3. In this study session, please note the following. 1. With the increasing need for the audit of corporate entities, it is therefore evident that a proper knowledge of the audit process is necessary for auditors to carry out their audit activities. Study Session 4. Audit Planning. Introduction. In conducting effective auditing, the auditor does not just merely commence his duty as an auditor. Effective and efficient planning is needed. Planning includes those activities carried out by the auditors to set out the work to be done in advance in an orderly and tactical manner. In order to facilitate maximum utilization of available resources and to achieve optimum results. Audit Planning. An audit plan is the strategy formulated for the audit work, which sets the direction for the audit, describes the expected scope and conduct of the audit, and provides guidance for the development of the audit program. It is a known fact that without careful planning, an audit will not be effectively and efficiently organized, controlled, or completed in a reasonable time. Aims of audit planning. The primary aim of audit planning is to make the financial statement error-free. Also, the time for reviewing and cross-checking financial events should be done in less time. Other aims include: 1. It enables the auditor to determine the strategy to be adopted during the course of his audit. 2. It enables the auditor to determine the time it will take to complete the audit assignment. 3. It enables the auditor to determine the cost of resources to complete the assignment. 4. It enables the auditor to determine the number of staff required for the audit assignment. 5. Audit planning assists the auditor to achieve his audit objective. 6. Audit planning helps to highlight areas of special audit emphasis. Sources of information on the nature of client's business. The auditor can obtain knowledge of the industry and the client from a number of sources. 1. Previous experience with the entity and the industry. 2. Discussion with people within the entity, for example directors and employees. 3. Visit the entity's place of business and plan facilities. 4. Publications related to the industry, for example journals. 5. Documents such as minutes of meetings, annual financial reports, operations and system manuals, budgets, marketing, and sales plans. 6. Prior year's tax returns. 7. Previous financial statement. Process of audit planning. The steps in planning an audit include: 1. Prior discussions with the client. 2. Review of audit documentation. 3. Make an inquiry on recent development. 4. Demand interim financial statement. 5. Consultation of non-audit personnel. 6. Staffing. 7. Timing. 8. Outside assistance. 9. Review of accounting principles and audit guidelines. 10. Planning a schedule with the time. Subheading. Factors to consider when formulating the audit plan. 1. Understanding the accounting and internal control system. 2. The auditor should seek to understand the accounting policies adopted by the entity and changes in these policies. 3. Reviewing matters raised in the previous year's audit, which may have continuing relevance in the current year. 4. Assessment of internal audit department and level of reliance to be placed on its work. 5. The auditor should also determine the number of audit staff required, experienced and special skills required, and the timing of the audit visits. 6. Consider any current or impending financial difficulties, which could face the company, for example shortage of raw materials or failure to raise working capital. Factors that may not allow the audit plan to be effectively achieved. 1. Shortage of qualified staff. This may be due to the anticipated high turnover of audit staff. 2. Lack of cooperation from the officers and management of the company. 3. Failure of management and staff of the enterprise to meet the agreed deadline. 4. Whether there is an unanticipated change in client business internal control system as well as an accounting system. 5. Unanticipated changes in government policies, as well as professional regulations or pronouncements, have a significant impact on the business of the company. How to minimize or eliminate these problems. 1. The auditor should liaise constantly with the management of the enterprise to ascertain any new development. 2. The auditor should agree on the planning, meeting with the management of the enterprise so as to ascertain the company financial timetable. 3. The budget should take into account contingencies. 4. He should monitor the environment to anticipate government legislation and professional pronouncement. Audit Planning Memorandum. The contents include the following. 1. Background information about the client and audit. 2. Matters requiring special attention during the audit. 3. Allocation of work to staff. 4. Audit time budget. 5. An outline of the approach to the budget. Reasons for documentation of audit plan. Several reasons justify the documentation of the audit plan. Some of the reasons include: 1. To provide a record of the audit for future references. 2. To provide a medium for communicating the audit plan to other members of the audit team. 3. To provide a basis for planning recurring audits. 4. To provide a basis for the review of the completed work. 5. To minimize any disagreement among members of the audit staff as regards their prospective responsibilities. 6. To provide evidence of the circumstances resulting in the auditor's audit approach decision. Audit budget. Audit budget is the qualitative statement prepared by the auditor in respect of an audit assignment setting out the resources required to carry out the audit engagement and the anticipated income from the audit assignment. Audit budget is mainly prepared to establish a basis for controlling the expenditure of resources for the audit assignment. It can also be used to determine the audit fee income. With audit budget, the number of staff to complete the audit assignment is ascertained. Generally, audit budget is used to determine the time it will take to complete the audit assignment. Benefits of an audit planning. 1. It helps to keep the audit cost at a reasonable level. 2. It helps the auditor obtain sufficient and appropriate evidence for the circumstances. 3. It helps to avoid misunderstandings with the client. 4. It helps to ensure that potential problems are promptly identified. 5. It helps to know the scope of the audit program by an auditor. 6. It helps to carry out the audit work smoothly in a well-defined manner. Summary of Study Session 4. In this study session, please note the following. 1. Audit planning is a core aspect of auditing. Like it has rightly been saying earlier, audit planning plays a very important role in carrying out an audit engagement, which gives room for adequate attention in this regard. 2. Proper process of performing an audit plan should be considered, which the core planning of the main is auditing. The process of planning an audit is the plan itself. When wrong processes are followed, the audit planning aims and objectives will be overly jeopardized. 3. Audit planning is not just to be performed and end at a particular engagement. There should be documentation of the audit plan for futuristic purposes. 4. Another aspect of audit planning should be considered as well, which helps in appreciating the concept of audit planning, such as an audit planning memorandum, which gives background information about the client and auditing business. Matters requiring special attention during the auditing are ascertained. 5. In accordance with international standard on auditing, audit planning become a priority in carrying out any audit engagement or assignment. Study Session 5. Controlling an audit. Introduction. Audit quality control is seen as the process of establishing standards of quality for products or services, establishing procedures and production methods that ought to ensure that the required standards of quality are met in a suitably high proportion of cases, and monitoring actual quality by taking control of actions when actual quality falls below standards. Controlling an audit. The auditor must ensure that the audit work has been performed to an acceptable standard in time with the approved auditing standard. 1. The work must also be in conformity with the statutory and contractual requirements of the auditing standards. 2. The auditor must also carry out his audit engagement in conformity with ethical standards, with the firm's professional standards. 3. The work is performed to an acceptable standard, economical ad proper, and discrete time scheduling. 4. According to the International Standard on Auditing, quality control politics and procedures should be implemented at both the level of the audit firm and on individual audits. Audit budget. An audit budget is a plan of action, qualified in monetary terms, prepared by the auditor, which shows the proposed resources required to carry out the audit assignment, as well as the expected income from the audit assignment. Quality control. This is a means by which a firm obtains reasonable assurance that its expression of audit opinion always reflects observance of approved auditing standards or other statutory obligations. Essentials of quality control include planning, controlling, and documentation. 1. Audit planning. 2. Audit documentation. 3. Engagement risk. Audit risk is the probability that despite having performed an audit with an appropriate level of care and in accordance with good practice, the results of the audit failed to detect the presence of significant error. Summary of Study Session 5. In this study session, please note the following. 1. As expressed, audit control is a very essential part of auditing. Control is a process for assuring compliance with professional standards for effective and efficient audit work to be done. 2. In allocating staff to audit assignments, factors such as audit budget, the scope of client's business as well as other factors must be incurred and monitored and reviewed. 3. The review of an audit helps in sampling the effectiveness of the overall procedures and ensuring effective performance of a particular audit. 4. Controls for all management positions should be carefully designed, put into writing, and firmly established as important matters of policy, and any override of such controls by these parties should not be tolerated. Study Session 6. Systems of Accounting, Internal Control, and Documentations. Introduction. Accounting systems are all procedures necessary for the recording of financial transactions, events, and other conditions in the books of account, which serve as the prerequisites for the preparation and presentation of the financial statements. The electronic accounting system is an accounting system, which uses the aid of a computer to operate in the organization. The system accounting has currently been used by most companies because of its numerous benefits. Internal control and audit documentation. Internal control system means all policies and procedures adopted by the management of an entity to assist in achieving management's objective of ensuring, as far as practicable, the orderly and efficient conduct of its business. Audit documentation are the recordings of information about the internal controls elicited by administering internal control questionnaire by the auditor in order to know the degree of reliance he will place on the internal controls. The information obtained can be recorded in a narrative form, graphical form, and combination of both. Systems of accounting. Accounting systems have been described by Oladapopoeo as all procedures necessary for the recording of transaction events and other conditions in the books of account for the preparation and presentation of financial statements. Types of the accounting systems. 1. Manual accounting system. This is the accounting system, which records transactions and other events without the use of a computer. 2. Electronic accounting system. This is an accounting system that is automated in recording transactions and events with the aid of a computer. 3. Internal control system. Internal control is the process, effected by an entity's board of trustees, management, and other personnel, designed to provide reasonable assurance regarding the achievement of objectives. 4. Internal control objectives. Internal control objectives are desired goals or conditions for a specific event cycle, which, if achieved, minimize the potential that waste, loss, unauthorized use, or misappropriation will occur. Audit documentation. It is important to document audit work performed in working papers to 1. Enable reporting partner to ensure all planned work has been completed adequately. 2. Provide details of work done for future reference. 3. Assist in planning and control of future audits. 4. Encourage a methodical approach. The objective of audit documentation. Audit documentation is necessary for the following reasons. 1. It provides evidence of the auditor's basis for a conclusion about the achievement of the overall objective. 2. It assists the engagement team to plan and perform the audit. 3. It assists team members responsible for supervision to direct, supervise and review audit work. 4. It enables the team to be accountable for its work. 5. It allows a record of matters of continuing significance to be retained. 6. It enables the conduct of quality control reviews and inspections, both internal and external. Form and content of audit documentation and working papers. The ESA requires documentation and working papers to be sufficiently complete and detailed to provide an overall understanding of the audit. Auditors cannot record everything they consider, therefore judgments must be used as to the extent of working papers. The form and content of working papers are affected by matters such as 1. The size and complexity of the entity. 2. The nature of the audit procedures to be performed. 3. The identified risks of material misstatement. 4. The significance of the audit evidence obtained. 5. The audit methodology and tools used. Examples of working papers. 1. Evidence of the planning process including audit programs and any changes there. 2. Evidence of the auditor's consideration of the work of internal audit and conclusions reached, analyses of transactions and balances. 3. A record of the nature, timing, extent, and results of audit procedures. 4. Evidence that the work performed was supervised and reviewed, an indication as to who performed the audit procedures and when they were performed. 5. Details of audit procedures applied regarding components whose financial statements are audited by another auditor. Audit files. For recurring audits, working papers may be split between permanent audit files, containing information of continuing importance to the audit. These contain 1. Engagement letters. 2. New client questionnaire. 3. The memorandum and articles. 4. Other legal documents such as prospectuses, leases, sales agreements. Current audit files, containing information of relevance to the current year's audit. These should be compiled on a timely basis after the completion of the audit and should contain 1. Financial statements. 2. Accounts checklists. 3. Management accounts details. 4. Audit planning memorandum. 5. Time budgets and summaries. Standardized and automated working papers. The use of standardized working papers may improve the efficiency of audit work, but they can be dangerous because they may lead to auditors mechanically following an approach without using audit judgment. The advantages of automated working papers. 1. The risk of errors is reduced. 2. The working papers will be neater and easier to review. 3. The time saved will be substantial as adjustments can be made easily to all working papers, including those summarizing the key analytical information. 4. Standard forms do not have to be carried to audit locations. Audit working papers can be transmitted for review via modem or fax facilities. Summary of Study Session 6. In this study session, please note the following. 1. The best system of accounting is an automated or computer-based accounting system. 2. Internal control objectives are desired goals or conditions for a specific event cycle. The internal control objectives include authorization, completeness, accuracy, validity, physical safeguards and security, error handling, and segregation of duties. 3. The types of internal controls are detective, preventive and corrective internal controls. 4. Internal control system is beneficial to both the management and the external auditor, and the internal auditors play a paramount role to ensure the efficiency of the internal control system. 5. Automated working paper packages make the documenting of audit work much easier. 6. The most widely used method to elicit information about internal control by an auditor is an internal control questionnaire, and the methods of documentation are narrative and flowchart. Study Session 7. Audit Testing Techniques. Introduction. The purpose of an audit of the financial statement is to express an opinion on them. In order to achieve this objective, the auditor performs various tests, mainly compliance and substantive tests, on the various components of the financial statements to enable him to obtain and evaluate appropriate audit evidence. Ideally, to support his audit opinion, the auditor should examine all transactions, all items in an account balance, and all controls for the period under review. Definition. An audit test is a sample taken from a larger population with the intent of testing the sample for certain characteristics, which are then extrapolated to the entire population. Audit procedures are the step-by-step approaches that are required during the period of the audit test. The following are conditions under which the auditor is expected to carry out 100% audit exercise. 1. Where the number of items is few, but of great significance to the financial statements. For example, plant and machinery, land and building, share capital. 2. Where an auditor has been put on inquiry by some events, for example where unexplainable alterations in sales records is noticed, the auditor should probe the matter to the bottom. 3. In high-risk area, the auditor would carry out a 100% checks to satisfy himself. 4. Circumstances where there is a one-off or extraordinary item. 5. Where as part of the engagements, the clients request a 100% check in some areas. 6. An area statutorily required to be disclosed. Stages involved in audit testing. There are 4 stages involved in the audit testing process, which are: 1. Planning the sample. 2. Select the items to be tested. 3. Testing the items selected. 4. Evaluating the results of the test. Types of testing. 1. Compliance test. 2. Substantive test. 3. Focused substantive test. Techniques for audit testing. 1. Inspection. 2. Observation. 3. Inquiring. 4. Computation. 5. Scanning. Testing of systems of internal control. 1. Purchases and trade creditors. 2. Sales system. 3. Salaries and wages system. 4. Inventory system. Summary of Study Session 7. In this study session, please note the following. 1. What do audit testing techniques and procedures basically mean? 2. We have also given a detailed analysis of the various types of testing, which basically are the compliance and substantive testing usually carried out by auditors. 3. We took a critical look at the categories of the substantive test, which are the test of details and analytical review. 4. We ended the topic by giving a brief analysis of different scenarios where an auditor can apply these testing techniques on. Study Session 8. Letter of Representation and Management Letter. Introduction. This study session introduces the nature and scope of a letter of representation and management letter. The purpose is to provide guidance on what constitutes a letter of representation and management letters, as this may be our core objective in this session. What is a representation letter? According to the Oxford Dictionary of Accounting, a letter of representation is a formal written record of representation made by the management of an organization to the auditors. The letter is prepared by management on a date as near as possible to the date of the auditor's report and after all audit work has been completed, including the review of events occurring after the statement of financial position date. International Standard on Auditing ISA 580 Management Representations. The purpose of this International Standard on Auditing is to establish standards and provide guidance on the use of management representations as audit evidence, the procedures to be applied in evaluating and documenting management representations, and the action to be taken if management refuses to provide appropriate representations. Obtaining a letter of representation. 1. The auditor should obtain appropriate representations from management. 2. Acknowledgement by management of its responsibility for the financial statements. 3. The auditor should obtain written representations from management on matters material to the financial statements when other sufficient appropriate audit evidence cannot reasonably be expected to exist. Forms and contents of the letter of representation. 1. Addressed to the auditor. 2. Dated as near as practicable, but not after the date of the audit report. 3. Usually drafted by the auditor, as he knows the areas on which he requires written representations. Refusal to provide written representation. If management refuses to provide the requested written representation, the auditor must 1. Discuss the matter with management. 2. Re-evaluate the integrity of management and reconsider the impact on other representation and audit evidence. 3. Take appropriate action, including considering the effect on the audit report. What are management letters? ISA 265, ISA 315 require the auditor to communicate material weaknesses in internal control identified during the audit to management. A deficiency is defined by ISA 265 where control is designed, implemented, or operated in such a way that it is unable to prevent, or detect and correct, misstatements in the financial statements on a timely basis, or via control necessary to prevent, or detect and correct, misstatements in the financial statements on a timely basis is missing. A significant deficiency is one, which merits the attention of those charged with governance. Management letter serves to identify to the organization areas in which the auditor has determined certain issues that the corporation may want to improve operations. These best practices fall into two categories, namely 1. Material internal control issues. Internal controls are the processes, systems, and procedures that help to ensure that all transactions are recorded properly. 2. Operating efficiencies. Sometimes it takes an independent auditor to identify inefficiencies that could be improved or new technologies that will improve operations. Summary of Study Session 8. In this study session, please note the following. 1. Letter of representation is written by the management to auditors and it forms part of audit evidence by the auditor. 2. The management letter is written by an auditor to management and the core reason is to report any material weakness on internal control of the organization, if any. Study Session 9. Post-Statement of Financial Position Events. Introduction. Post-balance sheet events refer to the adjusting or disclosure of transactions and events occurring after the date of the balance sheet, but before the financial statements of the company have been issued to the public or are available to be issued. The effects of post-statement of financial position events, to the already prepared statement of financial position. Basically, the preparation of a financial statement always involves making predictions about matters or issues or events relevant to the period in question covered by the financial statements, but the final effect of such predictions can only be known following the events which occur subsequently or after the statement of financial position date. Therefore, because most items in the financial statements are subject to some degree of judgment, in his examination of the financial statement the auditor is expected to express an inadequate judgment on those items. Classification of post-statement of financial position events. Generally, there are two categories of events or transactions that occur after the statement of financial position date that can have a material effect on the financial statements and need to be disclosed. They include 1. Events requiring adjustment. 2. Events not requiring adjustments. 3. Recognition and measurement. 4. Disclosure of post-balance sheet event. Going concern problem. One of the major decisions an auditor needs to take in relation to post-balance sheet events is whether any of those events gives an indication that the company cannot be regarded as a going concern. Some indications are: 1. Midway cancellation of major capital projects. 2. Heavy investments in new products that are not successful. 3. Overdue payments of pay deductions, VAT. 4. Declining material stock levels or unplanned overstocking of finished goods. Duties relating to post-statement of financial position events. The date on which the financial statements are approved by the directors is disclosed in the report. On this date, the auditor should assure himself that 1. The financial statements are complete in all material respect. 2. He is aware of all significant events up to date in his report. 3. Such events have all been accounted for in the financial statements. Post-statement of financial position review. It is part of the auditor's duty to carry out procedures which are collectively called post-statement of financial position review. The review, which will mainly consist of discussions with management, will also include 1. A review of the accounting records and all management accounts and information up to the date of the director's review of the accounts. 2. A review of the minutes of shareholders, directors, or management meetings and correspondence relating to items in the accounts. 3. A review of the profit forecast, cash flow projections, and all informal estimates made by the management. Summary of Study Session 9. In this study session, please note the following. 1. In light of the recent development and changes in firms brought about by events which are sometimes expected to occur, whose effect may be sporadic and drastic, positively or negatively affecting the financial statements on or after the date of the financial position, it becomes imperative to recognize and correctly ascertain these events and the magnitude and how they affect the growth and continuity of the firm. 2. For proper understanding and effective ascertainment, these events are grouped into two, viz., adjusting and non-adjusting events. 3. It however goes to hold that the post-balance sheet events, whether they necessitate adjustments or not, should be disclosed. 4. Furthermore, during the examination of these subsequent events, the auditor is bound to determine whether any event gives an indication that the company cannot be considered as a going concern. In his report, the auditor also discloses the date on which the financial statements are approved by the directors. 5. Finally, in the bid to ensure that the services carried out by the auditor are of a true and fair view, and that the events accounted for are correct and up to date, he carries out post-balance sheet review. Study Session 10. The nature and types of report writing in auditing. Introduction. Audit of financial statements is a major requirement of many organizations statutorily by law or by several policy guidelines. The scope of this study tends to cover report writing in auditing. The key concepts of this topic are auditing and report writing. Auditing and report writing. According to the auditing standards, auditing is the process of independently examining and expressing an opinion on the financial statement of an organization. It is significant to note that the audit function arose due to the need to separate ownership from control. The primary objective of auditing is to give a quality report on the affairs or financial statements of the organization. This then leads us to writing reports or report writing in auditing. Report writing is the formal opinion of audit findings. In later parts of this study, we would be discussing some of the reports that tend to arise in the course of an audit and how these reports tend to affect the audit process. This includes the Chairman's report, Directors' and Auditors' report. Some of the reports arising in the course of an audit include: 1. Chairman's report. 2. Director's report. 3. Discharge of auditor's responsibilities. Auditor's report. The auditor's report, which is usually at the end of the audit process, is a short statement, which expresses the auditor's opinion on the true and fair view of the financial statements prepared, on the extent of their compliance with statutory and legal requirements. Goals of audit report. Before delving into the specifics of writing an audit report, it is important to have a broad view of the major objectives of all audit reports. These goals are: 1. Illustrating nonconformities. The main goal of any audit report is to illustrate where the organization does not conform with whatever standard, rule, regulation or objective that it is supposed to. 2. Outlining positives. An audit report should not just include negatives. This is especially true for compliance reports and operational audits. 3. Opportunities for improvement. Beyond indicating things that are not conforming to requirements, it is important to also indicate high-risk areas, or areas that may be in compliance but are at risk of eventually not complying or could be improved. Characteristics of audit report. 1. A clear title, note the word independent. 2. It is addressed to the shareholders. 3. Precise identification of what is and what is not being audited. 4. The responsibility of the financial statements rests upon the directors. 5. Mention who the auditors are and the date of the report. Dating the report. The standard states that auditors should not express an opinion on the financial statements until those statements and other financial information contained in a report of which the audited financial statements form a part is approved by the directors and the auditors have considered all necessarily available evidence. Thus the auditor will only sign after 1. Report of the financial statements and accompanying documents in the format approved by the directors for release. 2. Review of all the documents which they should consider in addition to the financial statements. 3. Completion of all necessary procedures necessary to form an opinion including a review of post-balance sheet events. Contents of an auditor's report. The content of an auditor's report is dictated by 1. Statutes. These include Companies and Allied Matters Act 1990 and BOFIA 1991 as amended till date. 2. Statement of Auditing Standards. 3. Other authoritative requirements. 4. Circumstances. Statutory Requirements. Section 360, 1 of 1990 requires the auditor to state in his or her report, 1. Whether the company has kept proper accounting records and proper returns adequate for their audit. 2. Whether the company's statement of financial position and financial performance are in agreement with the accounting records. Types of audit opinion. They are of two major types, unqualified audit opinion, and qualified audit opinion. 1. Unqualified audit opinion. Here the auditor gives a clear unqualified opinion. If a report is silent on the provisions stated in Section 360, 1 of 1990, it implies that all provisions have been met. 2. Qualified audit opinion. An audit report containing a qualified opinion is also called a qualified report. The auditor may qualify his opinion in an audit report. The auditor expresses a qualified opinion when 3. Adverse opinion. An audit report containing an adverse opinion is also called an adverse report. The auditor shall express an adverse opinion when the auditor has obtained sufficient appropriate audit evidence, concludes that misstatements, i.e. individually or in the aggregate, are both material and pervasive to the financial statements. 4. Disclaimer of opinion. An audit report containing a disclaimer of opinion is also called a disclaimer report. The auditor shall disclaim an opinion when the auditor is unable to obtain sufficient appropriate audit evidence on which to base the opinion, and the auditor concludes that the possible effects on the financial statements of undetected misstatements, if any, could be both material and pervasive. Forms of qualification. 1. Limitation of scope means a limitation of the scope of the auditor's work that prevents them from obtaining sufficient evidence to express an unqualified opinion. 2. Disagreement means that the auditors do not agree with the accounting treatment or disclosure of some item in the accounts. 3. Less material means when the effect of the limitation is not as material or pervasive as to require a disclaimer. Similarly, when the disagreement is not as material or pervasive as to require an adverse opinion. 4. Adverse opinion. This is one where the auditors state that the financial statements do not give a true and fair view. Summary of Study Session 10. In this study session, please note the following. 1. The chairman and director's reports take place during the audit process while the auditor's report is the end product of the audit process. The various reports should not contradict each other, which will enable the auditor to give an unqualified opinion. 2. The reports given by the auditor should be independent of the directors or chairman of the organization so as to ensure that the auditor's opinion on the financial statements is expressing a true view of the financial statements.